The global stagflation shock of 2022. How bad could it get? How the confluence of epidemic and war has caused worldwide inflation. Considering all of this, which country is having the worst inflation? Why did experts not expect a rebound in the 1970s? Want to know all about it? If yes, then stay tuned. Hello everyone, welcome back to Studying Scholar. Today we will talk about the shocking biggest inflation of history in 2022. But before we begin, make sure you subscribe to our channel and click the bell icon so you don't miss any of our amazing videos. And let's begin. Last year, many financial experts thought that 2022 would be a strong time for the economy to come back. After COVID, businesses would be able to run at full speed again. People would be able to spend their saved money on vacations and other things they hadn't been able to do because of the pandemic. Some people said it would be like the Roaring '20s, the decade of spending that came after the flu epidemic of 1918 to 1921. After a few months, the 1970s, when the Arab oil crisis led to a long period of hard times for the economy, are often used as a comparison. Even though economies around the world were not growing, inflation rose to double-digit levels. This painful combination of high prices and low progress is what we call stagflation. But why did it happen? Why did inflation rose and the economic growth decline? Let me tell you this in detail. Now, stagflation is likely to happen again. After the simultaneous shock of COVID-19 and the Russian invasion of Ukraine, high inflation has surpassed estimates, soaring to the highest levels in decades in a number of nations, while growth prospects are rapidly declining. The thought of stagflation coming back scares us because there aren't many ways for us to deal with it financially. Inflation may be reduced by increasing interest rates, but rising borrowing costs would have a negative impact on economic growth, which is not all good for us. Maintaining loose monetary policy, meanwhile, risks driving up prices. If I say the majority of researchers and economists, including the IMF, do not anticipate a repeat of the 1970s, a period of economic depression that caused chaos for individuals and businesses. Inflation is not as high as it was previously. There are more independent central banks and financial support, which is protecting the most vulnerable. If you have heard about the 1970s, it looks similar to how the energy crisis of the 1970s resonated throughout the global economy. Pandemics and conflict have placed enormous pressure on the global supply of commodities and services today. Prior to the outbreak of war in Ukraine, prices had risen in multi-decade highs in many nations, including the US, the UK, and the Eurozone, as the pandemic disrupted supply chains, increased demand for goods, and prompted accommodating monetary policies and expansive fiscal stimulation. These issues were only worsened by the conflict. Russia and Ukraine provide a major portion of the world's supply of gas, oil, wheat, fertilizers, and other resources, rising energy and food prices, particularly in Europe. Indermit Gill, the World Bank's Vice President for Equitable Growth, Finance, and Institutions, says this is the biggest commodity shock we've faced since the 1970s. He continues by saying prices could be substantially higher than currently forecast in this lengthy war or new sanctions against Russia. Global economic growth is now expected to average only 3.3% this year, down from 4.1% in January, before the war, while global inflation is expected to be 6.2%, 2.25% higher than in January. Similarly, the IMF has reduced its prediction for 143 economies this year, which account for 86% of world GDP. Stagflation is significant because few economists agree on how to prevent it once it has begun. It also causes long-term harm to enterprises and middle and lower-income households. Kristalina Georgieva, managing director of the International Monetary Fund, says that growth is slowing and inflation is rising in economic terms, while in human terms, people's salaries are declining while their hardship is increasing. I believe this is an accurate comparison of today's economic situation. Now let's discuss more in depth. Considering the worldwide flow, how every country is facing consequences? The 2022 stagflationary shock is truly global, with divergence growth and inflation expectations across most nations, and many distinct factors worsening the trend in a synchronized manner. As expectations for the year deteriorate, similar tendencies can be observed playing out in country after country. A surprising jump in prices and a fall in activity during the last several months is clearly seen. Strong growth expectations in Asia have been cut down due to headwinds from the Ukraine conflict, as well as continuing supply disruptions and reduced demand caused by China's new lockdowns and Xi Jinping's zero-COVID policy. Asia's inflation is lower than that of other regions, but it is beginning to rise as a result of the recent global spike in food and energy costs. South Korean consumer prices touched a decade-long high in March, for example. The severe monetary policy tightening in various Latin American countries, particularly Brazil, has resulted in a rapidly deteriorating economic outlook. On April 27, the UN's Economic Commission for Latin America and the Caribbean downgraded growth forecasts for the area, citing a complex confluence of issues related to the conflict in Ukraine. World Bank President David Malpass said the war's impacts are being felt worldwide as rising energy and food costs harm the most disadvantaged, particularly in Africa and the Middle East, despite the conflict being restricted to Europe. However, it's no surprise that Europe is feeling the weight of the war's economic impact the most, particularly in countries that depend significantly on Russian oil and gas. Russia supplies 40% of the EU's gas, making the entire continent vulnerable to energy supply interruptions. Consumer energy prices have already risen, and business and consumer mood has taken a nosedive. Many analysts fear that a ban on Russian gas by the EU would set off one of the worst recessions in Germany and the Eurozone in recent decades. Gazprom's announcement last week that it might cut off supplies to Poland and Bulgaria shows that Russian retaliation on energy exports is also a danger to the region's economic prospects. Europe can face another economic crisis if Moscow suddenly halts the delivery of natural gas to Germany and other EU nations. Tom Holland at Gavical Research says that Europe will find itself wrestling with an existential threat to the single currency's future. Many economists, including Andrew Kenningham, the chief Europe economist at Capital Economics, say that this will be a year of stagflation in the Eurozone. High energy prices are another reason that will keep inflation high, making it harder for people to pay their bills and hurt business confidence. Germany, on the other hand, with its energy-intensive, huge industrial sector and export-oriented economy, is among the hardest hit. Economic growth in Germany has been halved by experts in the last 6 months, while inflation estimates have tripled. However, despite the UK's departure from the European Union and a predicted decline in real income this year, the country's economy continues to face similar challenges from rising energy costs and flattened growth. But Anatoly Kaletsky, an economist at the investment research company Gavical, says that the U.S. has by far the highest risk of dramatic inflation and wage price spirals. Inflation reached 8.5% in March, and investors think it will go up even more. The economy shrank in the first quarter, which was not what was expected. Even Dan Striven, an economist at Goldman Sachs, says that the U.S. job market is the most overheated it has been since World War II, with over 5 million more job openings than unemployed people. According to former Treasury Secretary Larry Summers, the overheated state of the labor market suggests a very low possibility that the Federal Reserve can cut inflation without inflicting a considerable slowdown in economic growth. The health of the job market affects what policymakers should do about high inflation, which in turn affects how much it costs to borrow money and how well people live. Higher wage growth and higher core inflation, which doesn't include food and energy, have made people in the UK and the US think that rates will go up more than once. However, if we take inflation in a positive way, how can we control it? In general, the central bank and/or the government regulate inflation. Monetary policy is the primary tool changing interest rates. In theory, however, there are several strategies for controlling inflation, including monetary policy, control of the money supply, supply-side strategies, fiscal policy, and wage price controls. Considering the worst inflation in 2022, what will be the inflation rate for 2023? What is the expected inflation rate for the next 5 years? Will the economy rebound again remains the biggest question. And that's for today's video. We sincerely hope you enjoyed the video. If so, give it a like and share it with your friends and family. Let us know if you have any questions or comments in the section below. Don't forget to subscribe to our YouTube channel to see more of our incredible videos. You can also watch our other videos that have been specially selected for you. Look forward to seeing you in the next video.